Hello, everyone, and welcome to our presentation. My name is Joe Militello, and today I wanted to talk to you about the power of using a guaranteed account for retirement and retirement income. If you currently have a 401k, an IRA, maybe a SEP, or you depend on some stocks for an investment accounts and to prepare for your future and your retirement, you might want to consider reallocating a portion of those funds in a guaranteed account so you can have safety with your money and predictability, of knowing that it's going to be there and also what you're going to receive out of that. And that's what we want to talk about today is using that type of an account. So let's go ahead and get started. Traditional retirement accounts were set up typically as a pension plan from an employer. It was an employer-sponsored plan, and the deal pretty much went, you come work for us, and you work here so many years, and when you retire, we'll promise you a pension plan with X amount of dollars for the rest of your life. Well, that worked out okay in the past, but you and I both know that pension plans, or at least company or corporate sponsored pension plans, have pretty much fallen to the wayside, and they're almost non-existent. Very few people that I meet with actually have a company-sponsored pension plan. Well, what happened traditionally, the employers finally got to a point where they said, hey, you know what? We don't want to take the burden of these accounts anymore. And I say burden because here's what happened. They promise you a pension, and in order to maintain that or to actually deliver on the promise that they gave you and to receive that X amount of dollars every single month for the rest of your life, they had to make sure those accounts, those investment accounts, stayed at par at best, okay? And what happened was when the market got volatile and it lost money and their account values dropped, it was the employer's obligation to make up that difference. Well, as you can imagine, that got old real quick with the corporations, and they said, hey, we want to do away with that. So what they ended up doing is transferring that burden to the employees in the form of a 401k. Now, they tried to make you feel all warm and fuzzy about it, said, hey, don't worry, you still have a pension plan. And they sold it to you as, you're going to be taken care of. We'll just take a portion of each one of your pay periods, your paychecks. We'll put it into the 401k account, and you'll never see the money until you retire. Well, that sounds good on the surface, but the problem with that is most qualified plans end up falling short. And we want to teach you how to make sure that that doesn't happen to you. The big problem is that we face today with these accounts, and the reason they fall short is we're in a global economy, and we face more volatility within a global market. When we were a nationally based market, it was a little more easy to predict what might be going on, or at least to stay with the trends a little better than we can follow today. Everything changes so fast. Stocks can be traded in a matter of minutes. You can do it on your smartphone. I've seen people do it. A lot of folks do. With those issues that we face, something happens in another country, you watch it on the news every day, the stocks get affected. The fear factor comes in, people start yanking money, selling off, whatever the case may be. So we've got too much volatility to have a predictable retirement, okay? Problem is, can you make up that difference? When that market becomes volatile and you lose value to your account, unlike the corporate sponsored pension plan where they're making up the difference, as an employee, can we make up that difference? Most of the time, that's no. I mean, if your account value drops $10,000 in 1 year, are you going to be able to come up with an extra 10 grand to put that back into your account to stay on track? Again, 99.9% of the time, that's a big no. And that goes for pretty much all of us, okay? See, the problem, you and I and everyone else out there in America have been taught to use traditional retirement accounts, such as the 401k or a SEP, an IRA. There's even 403bs. And of course, you've got your stocks and bonds. And traditionally, we've always been taught to go here and to invest with these accounts. And unfortunately, we think that's really the only place to go. So the problem that we're going to face with that is, again, more risk and volatility. So, and that risk, of course, means loss, capital loss to your accounts. No guarantees with these accounts. And today you're going to hear me talk a little bit about guaranteed. I'm going to say it quite a bit because these accounts are guaranteed. And some people might say, well, guarantee, most investment accounts or all investment accounts don't have any guarantee because there is the ups and downs in the market. And the guarantees that they think of, maybe a bank account or possibly a CD. Well, those are safe places and those are guaranteed accounts, but the problem is there's no increase in your capital. You're not really getting any growth in your accounts. Now, with our accounts, not only are they guaranteed, but you're also going to be able to make some money. Safety and predictability. We're going to talk a lot about that today. Another thing that I do is when I sit down with clients, I break down your current financial position in the color of money. Okay. Is it red? Is it green? Red, of course, is a risk factor. That's what I call your risk money. Green is your safe money. And when I, again, talk about the green money, we're talking about accounts that are not going to lose any principal value, are going to increase in capital growth, and have predictability of what you're going to be able to receive from that in the non-earning years. Okay, we're going to talk a lot about that today. One of the things you should be doing is asking yourself 3 important questions. Okay, one being, how safe are your current retirement accounts that you have now, wherever they're positioned or allocated? Are they safe? Are they subject to volatility? Is it time to review your current accounts and strategies? A lot of times I ask clients this, and most of them say, well, I put a plan in place about 10, 15 years ago. Well, you really need to sit down and revisit that because things change quite a bit, especially with the way our economy has gone over the past few years. Have you considered your entire lifestyle needs and income throughout retirement? Okay, this is kind of the surprising one to me. When I ask folks, well, what are your lifestyle needs for retirement? Now I get a lot of answers. Most people say, well, we want to travel, we want to visit family, we want to do this, that, or the other. And that's great. Most people have those plans. I said, okay, fantastic. But how did you prepare for that? What kind of income do you need to actually maintain that lifestyle? And those are the questions that are hard to answer for folks because of not having that predictability in the market. Okay. Market trends dictate the value of your money. Of course, market goes up, you have an increase, which is great. But if it goes down, guess what? Yep, you're losing. Okay. Again, you're going to have lost opportunity cost of money when your capital decreases. And lost opportunity cost of your money is a huge retirement killer. Anytime your money is in the negative or is not making any growth or creating growth for you, it's what I refer to as lost opportunity cost because your money should be increasing annually. Loss overshadows gains. One of the things that I like to point out to folks is I'm a bit of an educator. I firmly believe that I need to teach people the reasons why we do the things that we do and to have the understanding of what's actually happening with their money. So when I say loss overshadows gains, what I'm saying is the percentage of return that's required to recapture that gain is greater. Okay. And I got a small graph here that I want to illustrate that with. And if you're looking at the screen, you can see our account has a starting value of $100,000. We're going to choose a basic $100,000 for an example. We've got a return column, which is the second column here. We've got a value column, which is going to show you your value after the return or the loss of, and then a column for required to break even. Now, as you can see, if you have a loss in your account and the account value decreases, you need a higher percentage to get back to where you originally were. Okay. Let's just say if your account lost 20% of its value, you're going to need 25% to recapture that same 80,000. Now, the reason that I point this out is because it's a major factor in your non-earning years or when you stop contributing to your retirement accounts. And I'm going to illustrate that as we go on. Market losses in retirement can impact you more significantly. In the beginning, when you first started to save or early on in a career, you've got a little bit of time on your side. So if you did suffer a bit of a loss, you were able to recapture that because you had the time. Okay. If you're in your 20s, 30s, even 40s, you've got a little bit of time. But if you're approaching retirement or maybe 5 years out or even 10 years out with a significant loss in account value, that can severely dictate how and when you're going to be able to retire. Okay. As you prepare to take cash from your nest egg, which is any one of your retirement accounts, wherever that might be allocated, market losses right before or as you begin retirement not only diminish years of smart saving, but they can increase your risk of running out of retirement income or maybe money you wanted to leave behind to maybe kids or grandkids or a charity or a church, anything like that. It's a game changer. Again, These are the unpredictability that we can't see when we have traditional methods in place. The principle that I'm talking about is known as the sequence of returns risk. This is where the possibility comes into place where you can actually run or fall short of income in your lifetime. And I've seen it happen far too many times with folks. Okay. Now, here's the graph I was talking about earlier. This graph illustrates a loss. This is a sequence of returns risk right here. If you have a properly designed account and you are earning money in the beginning and continuously and have protection throughout your retirement years, you can end up, give me my cursor back here, with a positive amount of cash. Okay. Now these two accounts, there's two accounts here with two values. They both start off at $500,000 each. Now, roughly at age 66, we're going to assume that you retired at 65. And this is at year end, you turning 66, and your account value with an upside in the market has an increase in your capital. That's great. But if you suffer a downside or the downturn in the market, and all of a sudden you have a loss to your account, look what happens. You are significantly under where you started. Now, the bigger problem comes in when you are going to live off this money and you're taking what we call RMDs, or required minimum distribution, to live off of to fund your retirement years. It's going to drastically decrease the amount of money that you have in your account. It's like a double ding. Okay. You got to think of it as a double loss. The market affected your account and you took a principal loss there, but now subtract out to this column does not show you required minimum distribution taken out of the account. So that's what happens here. And that we can't illustrate everything into one graph, but once you're seeing that, look what happens. Age 84 here, 0. This account is up. This account has absolutely nothing in it. And again, time and time again, I've seen this happen to far too many clients. And that's the risk factor that we're going to try to help you defeat, of course. Now, one of the other reasons that I point this stuff out is because today in our modern society, people are living longer. Okay. And longevity is a problem. Especially, a lot of folks are living to be, into their 90s. Okay. And if you're looking at the graph that I've got on the screen now, you can see the percentage of people are living longer. Of course, women are statistically going to live longer than men. 10% will live to be almost age 100. That's a long ways off. Okay. Even from retirement. 25% as age 94. That's a pretty large percentage. Now, 50% will live to be almost 90. Okay, that's a very large percentage for anyone. If you ask me, I'll be happy to make it that far. And as you can see, I'm going to jump over the men's column. Of course, is a little bit less than the woman's, but as a married couple or a spouse, 92, 50% of couples will live, someone will live to be age 92 and 25 to be 97. So you can see as the years go by, the percentages are going to start to work against you. And if you run out of money at age 84 or 85, what happens if you live to be 90, 92, or 95 or 100 years old? Okay. Huge, significant problem. Major problem. Now, the big question, everyone says, well, what's the solution? Is there one? Absolutely. We do have a solution. And that's what we're here to talk about today is our guaranteed account. We use these accounts as private pensions. Okay. Principally guaranteed. Guaranteed growth. We're going to go over that in just a minute. Okay. If you are depending on a 401k or an IRA or stocks or bonds or 403bs or anything of the like, this is an account where you can roll your money over to. Do you need to roll over a 401k or an IRA? Do you have cash in the bank that you want to put somewhere that's going to get positive growth, guaranteed principal protection, anything like that? This is the account for you. Guarantees. Remember I said we're going to talk about that quite a bit? Let's talk about the guarantees. One of the problems that many people face or issues that we all face is the solution to solve the safety and predictability of their retirement accounts. Okay. Safety and predictability is a guaranteed account will help you protect what you've already accumulated. So as I just mentioned, if you've already got the 401k in place or another qualified plan that you are considering rolling over, or you just don't like the effect of the downside of the markets, we should talk about this. In addition to the guaranteed with this account, there's many positive attributes. This account is also can aid in protecting your estate. And I'm going to go over some of those attributes right now. We're going to talk about everything that's positive on this account. Okay. Initially, upon placing or allocating funds to this account, it pays an 8% signing bonus. That in itself is very, very big. So let's use that same $100,000 example. Let's say you rolled over 100,000 from a 401k or IRA or wherever that money might be. From day one, your account value is going to be bonused 8%. So your account will start at 108,000 from day one, not at year end, but from day one. We have illustrations that'll show you that as well. Your account guarantees your principal. See, with these accounts, they're making sure that you don't lose any of your money. So your principal is protected. Any of your purchase payments, anything that goes into this account will be safe. If the market drops, you're going to stay safe. And I have a graph for that we're going to look at in just a minute. It's guaranteed as part of the contract with these accounts. This account also pays guaranteed compounded growth. Now, this is a huge factor when it comes to accumulating growth inside of your account. You know, we've all been sold how to chase a rate of return. You and I and everyone else out there, the first thing I hear out of people's mouths is when I sit down with them, well, what's the rate of return? You know, and a rate of return is a necessity, but it's not the factor when it comes to actual real dollars and cents, because an average rate of return does not add up. And what I mean by that is math is not money and money is not math. An average rate of return can actually end up with less money than when you started. And we've got illustrations for that, but we just can't get into that right now with a short presentation. The huge thing that I like, of course, is guaranteed income for life. These accounts will, upon allocating money to these funds to this account, you will be issued a certain percentage of retirement income, depending on when you want to start to, take those payments and how much you allocate to the account, and they will be guaranteed for the rest of your life. No matter what happens, no matter what age you live to, contractually bound guaranteed income payments for life. Okay. Very, very big. That's the big thing for me. I love the income for life. It also provides a home health care doubler. Okay. Unlike any retirement account, there's no protection for long-term care. Now, this can be a major problem too. I've seen people run into these issues with long-term care with parents and loved ones, and it wipes out the entire estate. Long-term care is very, very costly. Okay. I've seen monthly bills for long-term care in excess of $7,500 per month. If you needed full care, that's very, very expensive. And you cannot fall back on Medicaid to help take care of that stuff because they will liquidate your accounts as well. You're only allowed to keep so much money when you have to rely on that. What a home health care doubler does is it will double the income that you're being paid currently for up to 5 years. Okay, so let's just say you're receiving $50,000 a year retirement income from this specific account. If anything arises where you needed that help, whether it was full-time or just maybe home health care, something of that type, they would increase that $50,000 to $100,000 for up to 5 years to offset the cost of that additional care. That's another big aspect of these accounts that I love a lot because they're looking out for you, the individual. They're trying to say, look, we know what's going to come. 65% of people that are 60 years or older need some type of long-term care. And that's a huge percentage. That's 6 out of 10 people, folks. 6 out of 10 people are going to need some type of long-term care. And it's costly. It's very costly. And you're going to need a way to pay for that. And if needed with these accounts, in addition to retirement income, it will allow you to take an additional 10% withdrawal on your account value, absolutely penalty free. Okay. So that's another bonus that I love about this. These are the positive attributes about this account. Actually, everything that we see here today is guaranteed in writing by the contract through the companies. We're going to have full illustrations for you. We can receive that at any time that you wish. Now, I just want to go over a quick graph with you, and I want just to give you an understanding or a better understanding of how these accounts illustrate and the growth works, okay? As you can see, the yellow line is an account value, okay? That's where your money starts. The red indicates we're using an example of the S&P 500, and as you can tell, it takes its typical market ups and downs. With our account, with our guaranteed account and compounded growth increases every single year. So your money, the value of your money increases linearly. It always goes up. It never goes down. So regardless if the market's up or if the market's down, you're going to receive compounded growth every single year. Here's where the difference comes in. When you get to that retirement age, do you want to retire here when your account value is only at 125,000, or do you want to retire up here when it's almost $100,000? Well, it is. It's a little more than $100,000 more. That's where your income is going to be based on. Okay. And this is just using only $100,000 value. True value of your money. When your account, when the stock market drops, you stay even. You keep increasing. That is huge, folks. That is the power of guaranteed right there. That is safety and predictability, because you know your money's safe. You're not going to lose anything. And you're going to be able to predict at any given year what income you're going to be able to receive for the rest of your life. Unheard of out there. Okay. The money's there. The account's there. The income's going to be there. In comparison to using a guaranteed account, ask yourself these questions. Wherever your money's allocated right now, is it safe? Is the income predictable? And is your account value guaranteed? Can you predict what you're going to get out of that in the future? Like you can with my account. Does your current account provide the same benefits as the guaranteed account? Now we're talking about long-term care coverage, principal protection, the bonus, the additional 10% withdrawal, penalty free. Do your accounts currently have these positive attributes to it? And of course, a big question is, wherever your money's at now, will it last as long as you do? Again, folks, it might seem like, or you anticipate that your account should last for as long as you do, but without guarantees in place, typically, not always, but typically they fall short. And what we do is we help you focus on preparing that game plan in your life stage. See, I look at 3 life stages. Your first being accumulation stage, your second being preservation, and your third being distribution. Typical traditional financial advisors are out there to help you increase your capital, to help you grow your money. And that's a good thing. But they only focus on the accumulation phase in most cases. Very rarely do I see anyone focus on preservation or in the distribution phase. They don't have guarantees in place for you. Everything's involved into the markets, and you've got your ups and downs, and that's how they sell it. There's a risk factor. What is your risk tolerance? And risk tolerance is just a nice way to ask you, how much money can you stomach to lose? So if you're considering reevaluating your current financial position or your retirement strategies, or you want to explore some other avenues for safety and predictability, or you just want to guarantee your money, you want to know it's there, and you want to know what kind of income you're going to have for life so you can plan for the future and have a predictable outcome, this is the account for you. And we're always available. I suggest to get in touch with us. We've got free brochures. If you're looking for more information, just get in contact with us. We can send you brochures, absolutely free, of course. And they have a complete breakdown of these accounts, where they're guaranteed, how they're guaranteed, and the functionality of it and how they absolutely work. To give you a quick example, these accounts are a triple index. Okay, there's 3 indices that it's invested through, and that's the reason why that we can guarantee these, because it has an 88% success ratio. They're evaluated annually. Every 12 months, they evaluate every company, and they make sure they know beyond a shadow of a doubt where the money's going and how much growth they can earn. Okay, that is the guarantees, and that's why they can issue a guarantee with these accounts. So don't hesitate to call us. You can either get in touch with us through email at info@infinitewealthinc.com. Send us a quick email, or just call the office direct, 586-200-1033. And you can talk to us directly, leave us a message after hours, whatever it might be, and we will forward those to you by mail or email and give you all that information. Or we can meet, talk some numbers, and we can run full illustrations for you. So if you really want to know how the accounts will function with the money that you have, we can prepare a full illustration. It's in black and white. You can see all the numbers, and you'll be able to see the safety and predictability that's involved. Folks, thanks for watching the presentation. Get in touch with us as soon as you can.